Buying stock these days is very difficult. There's a lot of uncertainties, the market is trading at all-time high, and you're afraid to make a big mistakes. Therefore, you're sitting on cash, you wait, and you let that train go because you know that waiting is a losing game. So therefore, I decided to offer you my 3 favorite picks on the Canadian market today. And make sure to subscribe and like this channel because next week we're going to review my 3 favorite dividend growers on the US side. So let's get started with one of my largest holdings, one of my favorite companies ever, National Bank. Yeah, I know, not a big surprise here, but there are a lot of good reasons to buy it now so you can enjoy the rest of the summer, and then it's going to continue to thrive in 24 and especially in 25. So what I love most about National Bank, it's its diversification. As opposed to the big other 5, National Bank is generating money from various business segments. Of course, it makes a lot of money from the banking and saving activities, so the classic banking activities, such as doing loans, doing mortgages, commercial loans, but they also generate a lot of money from financial markets, doing trades on the market as well, and also doing wealth management for retirees and also wealthy people. Finally, they have 11% of their revenues coming from their international business segment, which is comprised into actually 2 acquisitions, so Credigy in the US and ABA Bank in Cambodia. The bank is also acting as a super regional bank based in La Belle Province, where 50% of their classic banking activities are generated, but they are also present a little bit in Canada and outside of Canada with 19% of their revenue. So as you know, I like to match my investment thesis, so the narrative around the business, with facts. So the qualitative analysis with the quantitative analysis. So looking now at the dividend triangle from National Bank, those stats are coming from my website, Dividend Stocks Rock, where we provide you the dividend triangle for over 1,100 companies, both trading on the Canadian and the US markets. You see the past 10 years of what happened with National Bank. So being diversified, being flexible, going forward for generating more growth is clearly showing as revenue and earnings are following a similar path. And of course, the dividend is also the most generous in the past 5 and 10 years as opposed to the other big 5. So long story short, we do have a smaller bank here in Canada that is outperforming all the big guys. And one of the reasons why they're able to do that is they are more flexible and more diversified than most of them. Now, the most important reason, the most interesting reason to buy at National Bank right now is that they just went into a small dip. Why? Because they announced the acquisition of Canadian Western Bank at $5 billion. Actually, the deal is not done yet. There's still a play to be made on Canadian Western Bank as well. So you may want to look at it, this one, and determine if you are willing to take the risk to buy it around like $42, $43 and eventually maybe getting $52 for your shares. So that could be an interesting play, but I'm obviously more interested in why National Bank decided to make that offer. So first, Canadian Western Bank is based in Western, of course, and therefore it would allow National Bank to have a better diversification across their revenue, and there's also higher synergies than other banks if they would buy Canadian Western Bank, because therefore there's no more cannibalization for National Bank. The other thing that is really important here is the $30 billion in commercial loans. That opens the door big time for wealth management. As you can see at the bottom of this graph, those charts were taken from the investors presentation by National Bank. But what I found very interesting is on top of not having equipment finance at National Bank, which they will gain at Canadian Western Bank, well, CWB doesn't have like a full service of wealth management, which exactly is the case with National Bank with private banking 1859. And one of their core strategy at 1859 is to actually work with business owners. So during the time that they're building their business, so when they sell and they cash their checks, well, they're kind of like the first in line to pitch their wealth management products. So gathering $30 billion worth of commercial loan would be a major step forward for that strategy for National Bank, creating even more strategy, more synergies moving forward by doing cross-selling products. And one last thing I really like about this deal is the $30 billion in deposits coming from CWB. You may not know that, but if you want to be efficient and make a lot of money with capital markets as a bank, you need to maintain high level of capital, the commonly known as CET Tier 1 ratio. So you need that capital to be able to operate, and financial markets are actually getting a lot of this when you do those calculations in those ratios. So adding more deposits for National Bank is definitely a plus that will open the doors to more growth and more profitability in the future. Moving on to my second ideas, Dollarama DOL.TO. And this one, when you look at the dividend triangle, you're going to tell me, but Mike, what's the point of buying a stock that is almost trading at its all-time high? Well, I would argue back. Just look at the dividend triangle, dear investors. As you can see, revenue and earnings are actually growing ends in ends, almost at the same pace. What's even better, the dividend is following. Then again, you're going to say, but Mike, the dividend yield is incredibly low. I'm like, yeah, I get it. But this one is about buying a thriving companies that on top of that is also recession resistant. And I don't know about you, but I do expect some slowdown in the economy for Canada in the next 2 years. And I would say that a company selling cheap stuff between $1 and $5 could definitely show even more organic growth. Even more important, Dollarama has been able to introduce a lot of its own products to improve its margin over time. So as you can see, it was hovering around like 36-37% gross margin. Now we're getting close to 45. So even though they're selling small items, they are making a lot of money on those, and they definitely have the volume to generate healthy profit moving forward. The two major growth vectors for Dollarama in my mind is the fact that they have this ability to continue to open new stores in Canada. So they're right now around 1,500. They want to go by 2,000 stores by 2031. They have a strong brand recognition. They are the most recognized brand for dollar store across the country, and they are present pretty much everywhere where it is a Canadian. So this will continue to grow. They have plenty of growth opportunity over there. The second thing I really like about Dollarama is their investment in Dollar City. So they now own 61% of Dollar City, and Dollar City is present in like 5 countries in Central America. So expansion in Mexico, we have like Colombia, El Salvador, Guatemala, and Peru. So Central America and a little bit of South America. It's a very interesting play. So far, it's going well, and I really like the fact that Dollar City wants to almost double in size by 2031. So Dollarama will be able to benefit from both the growth in Canada and also the growth on international markets. So before we move on to my third ideas for this video, you probably wonder, how am I still investing with conviction? I'm always 100% invested, never in cash, and I'm just excited about my next move. This is all because I start from a very solid point, which any stock research should start with: a solid stock screener and a healthy dividend list. So I created the Rockstar list for you guys, which is a combination of all the Canadian and all the US stocks showing a strong dividend triangle, similar to what you've seen with National Bank and Dollarama. The point here is I follow important metrics that shows the business is thriving with increasing their sales, increasing their profit, and increasing their dividend. This list is also updated monthly, so if you subscribe to dividendstocksrock.com/rockstar, it's 100% free. You just put there your email. You're going to receive an updated list of the Rockstar list every single month. Finally, it is a great step if you want to protect your income at retirement, because there's nothing better than buying companies that are healthy, show robust balance sheet, and so show some growth vectors, right? So if you're looking for struggling companies with high yield, you're not going to find them in the Rockstar list. But if you're looking for something to stabilize your portfolio and start your research on the right foot, definitely this list is a must. So you can download it for free, dividendstocksrock.com/rockstar, and every single month you're going to receive it in your mailbox. Now, the last one, I've already discussed it not too long ago on my favorite plays on infrastructure, but I cannot help it because this business is a model of stability, and it's Toromont Industries, TIH.TO. I like the fact that they are selling equipment, they are renting some equipment, and they also offer product support. So they are well diversified for this. And they do businesses for a lot of different industries. So yes, the bulk of their revenue is coming from the construction industries, but there's also a lot of money coming from rental services, the mining industry, and Simco, which is kind of great because it's completely separate, which is offering services and equipment for refrigerating parts and equipment. So completely different from the construction and the mining business. So that helps also Toromont Industries to smoother the wave when the construction industry is slowing down. When you look at the dividend triangle, you will notice that it is a little bit more cyclical than the other two. So we see that revenue and earnings are not always growing at the same pace. Right now, we are entering into a slowdown, and I think it's a great time to maybe put it on your buy list. As you can see, the stock price almost reached $140. Now trading below 120, so that could make it very interesting to buy a long-standing Canadian dividend grower in your portfolio at a price that is not that bad because it's still trading around the same price it was in 2022, while revenues are better, earnings are better, and of course, dividend are better than the past 2 years. Finally, as I mentioned in my previous video about the infrastructure business, Toromont Industries is definitely at the right place at the right time. There are a lot of money flowing into infrastructure expenses to either in repair or construction or to construct more infrastructure in North America. And Toromont Industries is one of the leaders and sellers of Caterpillar equipment. So they benefit from a lot of organic growth coming from rental equipment and the support that they offer to their clients on top of having this flow of money coming from infrastructure. Even better, for a cyclical company showing 34 consecutive years of dividend increase, I'd argue that it's pretty much stable, and it's a great sign that this business is going to stay here for a long time. Now, I hope that you have enjoyed this video. Let me know in your comments what are your favorite Canadian dividend growers for the rest of 24 and going into 25. Maybe the reasons so we get a little bit more ideas than just those three. So give me a thumbs up, subscribe to the channel not to miss next video next week about my favorite 3 dividend growers to buy on the US side for the rest of 24. And until then, don't forget to stay invested.